Imagine waking up one morning and realizing that the government you voted for, your democracy, no longer decides the fate of your economy, and instead, an invisible force controls money, credit, and even the very prices you pay for food, fuel, and housing. And no, this isn't a dystopian fiction, it's the reality of the modern world. But how did we get here? When did money, not the people, start calling the shots? The story begins over a century ago, in an era where central banking was a controversial idea, where powerful financiers whispered behind closed doors, and where ordinary citizens had no idea that the fate of their wallets was being quietly handed over to institutions they didn't take control. Central banking did not appear overnight. It was born out of crises, wars, and political compromise. In the United States, the Federal Reserve Act of 1913 marked a tipping point. Before this, money supply and credit were largely managed by private banks, with the occasional panic reminding the public of systemic fragility. Enter key figures: Senator Nelson Aldrich, a wealthy industrialist; Paul Warburg, a European banking prodigy; and President Woodrow Wilson, a politician swayed by the promise of stability. Together, they created the Federal Reserve, a system designed to regulate money and control the flow of credit, but with a twist. It was quasi-private, independent of direct democratic oversight. The promise, stability; the reality, control over interest rates, over credit creation, over the financial fate of every citizen, and, crucially, a system largely insulated from the will of the people. To understand how central banking replaced democracy, we must first grasp the deep connection between money and power. Wealthy financiers have always had influence, but before central banks, this influence was indirect. Lobbying, political donations, and economic pressure. Central banking changed the rules. It gave a small group of people direct leverage over the economy without voters ever having a say. In Europe, a similar story unfolded. The Bank of England, founded in 1694, had long been a model of financial control cloaked in legitimacy. By the 19th century, this blueprint spread across nations. Central banks could issue currency, lend to governments, and manipulate credit, all ostensibly to stabilize economies, but in practice, they concentrated economic power. And there was a method to this. Governments constantly needed money, especially for wars. Central banks became the middlemen, issuing money on behalf of governments, profiting from interest, and quietly ensuring that financial priorities often outweighed democratic ones. The 20th century accelerated the power of central banks. The Great Depression was not just a failure of markets, it was a failure of oversight and policy. Governments wanted stability, but central banks wielded the levers of monetary policy. Interest rates, money printing, credit allocation, or controlled behind closed doors by unelected officials. World War II only intensified this trend. Governments needed money, and central banks provided it, but this also meant governments had less control over their own fiscal destiny. By controlling money supply, central banks could dictate inflation, debt, and economic growth, while citizens remained largely unaware of the invisible strings. Notice the pattern. Citizens vote for politicians. Politicians rely on funding and borrowing. Central banks control the money, and suddenly, elections cannot change the trajectory of debt or inflation. Democracy exists, but its power is symbolic rather than economic. There were moments when the world glimpsed the consequences of this system. The 1970s oil shock and stagflation. Central banks responded, but only after economies suffered massive damage. The 2008 financial crisis. Bailouts rescued banks, not citizens. Quantitative easing flooded markets with money, boosting asset prices while wage growth stagnated. In each case, the public was told that central banks were protecting them, but the truth is more unsettling. The levers of control allowed unelected authorities to manage economic outcomes on a scale far beyond democratic input. Citizens felt the pain, banks felt the relief. This is where the phrase democracy replaced by monetary control becomes concrete. Politicians cannot act without considering interest rates and central bank policy. Ordinary people cannot escape inflation or credit tightening. Even when governments seem to act, the rules of money are not theirs too, right? Fast forward to today. The pattern repeats itself with chilling consistency. In 2023, U.S. household debt hit a record $17 trillion. Inflation surged globally, while central banks raised interest rates. The result, home ownership became unreachable for many, and everyday expenses skyrocketed. And yet, policymakers argued, we must trust the central bank. Even emerging economies face the same squeeze. In Africa, Asia, and Latin America, loans from central banks or their foreign counterparts dictate public spending, often undermining social programs and democratic priorities. The data is stark. Nations with stronger central bank independence often enjoy macroeconomic stability, but at the cost of reduced democratic influence over fiscal priorities. Money becomes the ultimate arbiter, not the people. So, what does this mean for you? Every time interest rates rise, every time inflation eats your paycheck, every time government programs are cut due to budget constraints, you are witnessing the invisible hand of monetary control, not democracy, shaping your life. And yet, most citizens never connect the dots. They vote, they debate policy, but the ultimate power, the ability to create or withhold money, lies elsewhere. When the power to create money moves out of public hands, the consequences ripple through every corner of society. Citizens feel it in their wallets, governments feel it in their budgets, and even democracy itself begins to wobble. This is the fallout of central banking, quiet, invisible, but relentless. Consider the ordinary citizen. Inflation rises, credit tightens, mortgages, student loans, and credit card rates climb. Prices for essentials surge while wages stagnate. Meanwhile, large financial institutions, the very entities that central banks were designed to stabilize, a fan profit. The system, in essence, redistributes power from the many to the few. In the 2008 crisis, U.S. banks received $700 billion in bailouts. Citizens were encouraged to tighten their belts, pay down debt, and accept austerity measures. The economy recovered, but primarily for the wealthy. The same script repeats globally. From Greece in 2010 to Argentina in 2023, central banks dictate the rules. While democratic processes are reduced to symbolic gestures, governments have tried to fight back, but often in ways that only reinforce central bank control. Take austerity, cutting social programs, raising taxes, reducing public investment. These measures are framed as economic necessity, but they disproportionately harm citizens while leaving the banking system intact. On the other hand, stimulus packages, printing money or injecting liquidity, temporarily boost the economy, but unless structural issues are addressed, these measures fuel inflation and asset bubbles, giving the illusion of prosperity while deepening the underlying imbalance. Central banking thus creates a paradox. It stabilizes the system, but each fix strengthens the bank's control, not democracy. Citizens feel relief or pain, but the fundamental power imbalance remains. Look closely, and a pattern emerges. Every few decades, financial crises, central bank intervention, government response, citizen sacrifice, and eventual recovery for the elite. This cycle repeats globally. Asia, Europe, the Americas, different countries, same invisible hand. Even in the digital age, central banking continues to dominate. Modern tools like interest rate adjustments, quantitative easing, and digital currencies expand control. Governments and citizens may think they have agency, but the levers of economic destiny remain firmly in central bank hands. Consider this. Global debt recently surpassed $300 trillion. Central banks hold trillions in assets, controlling key interest rates and liquidity flows. Meanwhile, the bottom 50% of the global population owns less than 2% of total wealth. Inflation-adjusted wages have barely grown in decades for ordinary workers in developed economies. In other words, central banking has become a mechanism not just for stabilizing markets, but for concentrating wealth and controlling citizens' economic realities. Democracy becomes a concept, not a tool. Ask yourself, if governments cannot freely spend or invest without considering central bank mandates, how much influence do your votes really have? If your cost of living is dictated by interest rates and money supply decisions made in an office you cannot enter, is the economy truly democratic? Central banking does not replace democracy with overt tyranny. It's subtler. It shifts the balance of power away from elected officials and citizens toward a system that operates by economic logic rather than popular will. Decisions are justified as technical or neutral, but their consequences are deeply political. 3 clear takeaways. Visuals. Key points appear on screen as narrator speaks, narrator vo. Here are 3 lessons to take from this hidden history. 1. Money is power. Who controls the supply of money controls the economy and, increasingly, the political decisions of nations. 2. Democracy has limits. Voting matters, but in a world where central banks dictate fiscal reality, elections cannot fully determine economic outcomes. 3. Awareness is crucial. Understanding how central banking works allows citizens to question policy, protect personal wealth, and advocate for transparency. As technology evolves, so does monetary control. Digital currencies, programmable money, and AI-driven trading algorithms could further centralize power in ways invisible to the public. The day when money itself becomes programmable and directly enforceable by institutions is not distant, it is coming. Without scrutiny, this could transform central banking from a stabilizing force into a system that dictates how, when, and where citizens can spend, save, or invest. Democracy may survive in form, but its substance could be eroded entirely. The question is not whether central banks exist, they are here to stay. The question is whether citizens, through understanding and action, can influence a system designed to operate beyond their reach. Can democracy reclaim influence over the economy? Or has the day already come when money, not people, truly rules? If this video opened your eyes to the hidden powers shaping your life, share it with others. Discuss it with friends, family, and colleagues. Knowledge is the first step toward agency. And if you want more deep dives into the invisible systems that govern the world, from finance to geopolitics, subscribe and turn on notifications. The more we understand, the better we can navigate the economy that rules our lives.